Good morning, everyone, and thank you very much for joining me. This is the morning market review. It is the 16th of February, Friday, the 16th of February. My name is Russell Shaw. I'm a senior market specialist at FXCM. And what I'd like to do is just go through our disclaimers before we get on with the live stream. And I'll bring up the high risk investment warning first. Good morning, Katie. Hello, Raj and Mia. Pleasure to have you all on the live stream. Thank you very much for joining. I just want to keep this high risk investment warning on for a few more moments. I'm just going to keep the camera to the side just so you can have a clear view of the slide. All right, let's just go ahead and bring up our market commentaries disclaimer. Okay, terrific. Let's take a look at our real rate. Okay. So the real rate is it's interesting. Yesterday, what we said was we've got this big, long candlestick here, and that makes it quite complex to analyze with the next two candles really inside the length of that candlestick. So they actually called inside days. The issue that we have with rates at the moment is that they are heading up. Okay, they're heading up, and I think that is something that we just cannot get away from, and we're just going to have to acknowledge that at the moment rates are heading in this northeast direction, right? So the fact that they're moving in this northeast direction is important because it's a key driver of markets. Hey, Kim, good morning to you. What we mean, they are a key driver of markets. So first of all, when we're talking about the stock market or risk markets in general, we're talking about what we call the time value of money. And the time value of money is a very simple calculation. It's called present value. And then what we do is we just put future value divided by 1 plus, I'm just going to put I for interest rates. And typically, there's a time component as well. So we'll just put sort of to the power of, all right. The idea here is we're kind of getting to the point. Hey, Indran, good morning to you. We're getting to the point where obviously there is mathematics that is involved. I don't want to get too complex, except what we must understand is that the interest rate component, I've got to try and actually shrink this. Yeah, that's better. I wanted the camera was getting really sort of in the way of everything, right? What we've got to understand, okay, when we zoom in, is that this interest rate component, okay, the interest rate component, which is this guy here, 1 plus I, that's a denominator. And if it's a denominator, it's going to be inverse to the present value or the current values of the. Hey, Anna, good morning to you. It's going to be inverse in terms of relationship to the current value. So, current value of stock markets or risk markets. Okay. In other words, as we move up, the bottom component is moving up. The denominator is moving up. Well, if the denominator is moving up, and we've just said that it's got an inverse relationship to the present value, it would make sense on a mathematical basis that the present value has pressure to the downside. Now, let's see if that is in fact the case. If it's not taking place at the moment, we'll come back to the time value of money and try and explain it away with this formula. But let's just go to the S&P 500. Okay, let's see what's happening with the S&P 500, and then what we'll do is we'll take a look at, say, Nasdaq, keeping in mind of the inverse relationship of rate to present value. That's the key. So let's go ahead, let's bring up SPX 500. Let's just see what's happening there. And let's share. Okay, so it's really, really interesting. We've actually got this overbought condition on the S&P 500. Okay, I'm just going to take the stochastic out for now. The reason I want to take it out, the stochastic is a measure of momentum. To me, it's the best measure of momentum. That's just my personal opinion. I really enjoy looking at stochastic just because of the way its formula gives it a pure momentum play. But what we've done in our methodology is we've added RSI specifically to add a risk component. So when we go to overbought or oversold levels, but in this case overbought, it's introducing a concept of risk. Okay, now what I'm suggesting to you is that we've got this overbought condition on the weekly at a time. I'm going back now to the real rate at a time when the real rate is moving up. That to me is an uncomfortable position to be in. Why is it an uncomfortable position to be in? Is because we've got this time value of money formula. Let's just fix it up so we can see it. I just want to box it as follows. That's better. So this time value of money. Now, interest rates, we have to be fair to the formula. Okay, we have to be fair to the formula. The interest rate is not the only variable. Clearly, the numerator on the right side, the FV, the future value, is also a key variable. Now, I know we've been we're going a little bit in depth in terms of the mathematics. We're saying that the interest rate has an inverse relationship. As the interest rate moves up, so the present value gets pressure to the downside. But there is a counter to that. And that's the numerator. The numerator is the fair value or the cash flows. It's basically your fundamentals going forward. Do we expect the earnings per share of companies to be improving over the in the future? And if we're getting those cash flows up, we're talking about earnings. Let's also talk about free cash flow, etc. If we're getting those to lift up, that has a positive relationship with the present value. So I understand that we're having a sort of a complex discussion here. What the bottom line is that there's a whole lot of variables that are affecting the risk markets. One of the keys is the interest rates, which are heading in the wrong direction. Then we've got the future value or the earnings, which seem to be heading in the right direction. So far, earnings per share out of 75% have beaten expectations. Last night we saw Coinbase come out. Coinbase really ripped apart expectations. We've seen that time and time again. So there is this fundamentals that's moving them up. Where the point I'm trying to make here is that we've gone overbought on the S&P 500. To a large extent, I would expect the numerator to be priced in. To a large extent, I'll expect the earnings to be priced in, the forward guidance to be priced in. But I'm worried that we're not reflecting the risk that's coming in from the interest rates. Those interest rates are moving up. Yesterday, we had FOMC member Bostic come out and again talk down the possibility of a rate cut earlier. So the fact of the matter is, as we watch the interest rates move up, it is creating effectively what we call a headwind for the risk markets. Let's just take a look at Nasdaq and see what's happening on the NASDAQ side of things. Just using the weekly chart as well. Okay, we're not quite as overbought on the NASDAQ. That's interesting to me, and I'll tell you why it's interesting, because the NASDAQ's tending to be the leader, right? But we're not quite as over, but we're tending towards overbought. The fact that we're tending towards that 80 level on the RSI, I think, is something that we can, we should acknowledge, given the fact that given the fact that the yields are moving in that northeasterly direction. I just want to show you what I'm talking about. Yields moving in this northeasterly direction, and the fact that we've got them on the denominator side just makes it a little uneasy for me. The fact that the markets haven't quite reacted to the movement up in the interest rates. I just want to pause there. I understand we've done a lot this morning. I understand. Are there any questions? Are there any questions that you guys may have? Okay, let's go ahead and let's just put in the SP 500 underneath the NASDAQ, and we'll do some correlations here. Okay, so we're looking quite deep this morning. Let's just put in SPX 500, and we'll put that underneath the real rate. All right, so okay, I think this is good. This time frame is good. Let's just put in, here is the real rate moving up. Okay, that is the inverse, that is the pressure of the interest rates, okay, on the S&P 500. As the real rates move up, you can see that the S&P 500 is coming down. Then we get a reversal here. We've got the real rates coming down, and lo and behold, we've got the S&P 500 moving up. That all looks as the way it should. To me, that makes sense. Where there is a break now, what I think you guys can see what I'm talking about is over here. Just make this blue a little. There we go. Make it even thicker. There we go. Take a look at this blue vertical. You can see that the real rate is moving up, and the S&P is moving up. Can you see there's a break in that correlation? It should be an inverse correlation. It's gone positive. So the numerator, the cash flows, seem to be buoying up the S&P 500, but at some stage, I think that the higher interest rates have to bite. Okay, they have to bite, and if they bite, okay, S&P 500 has to come down. And again, remember that S&P 500 is overbought. So we at this kind of very important level on the S&P 500 where I think we have to be very careful. Katie asking for some fibs. You mean this way, Katie? Kind of like this? Let's just, oh my goodness. Let's just take these all out. Crikey. All right, let's just take these all out. Let's put in the 62%. Let's put in, is there 50%? Yeah, it's a 50%. Okay. Does that help, Katie? Here's the 50%, this blue line. I'll just zoom in. The blue line's for 50, and this sort of okay, so we're kind of moving towards the fibs, I guess, but I think the real story, KD, is the fact that we're moving northeast on the real rate, and I think we are moving northeast on the S&P, just at a time when that S&P 500 is overbought. Let's take a look at dollar. The dollar has a different relationship with the interest rates, whereas the risk markets will have an inverse relationship. Dollar has a positive relationship. Let's take a look at that. So let's just remove the drawings. Let's take the S&P out. Let's add dollar. Okay, let's put in plus over here. Let's put in US dollar. And this makes more sense. Okay, this makes more sense. So let's put in our arrows again. Here is the real rate moving up. Remember, the dollar has a positive relationship with the real rate. As rates move up, it increases the investment in dollar-denominated interest yielding assets, right, or fixed in the fixed income market. As the rate comes down over here, so you can see that the dollar comes down here, and here we have this movement to the. So here we get this movement to the northeast, and what do we get on the dollar? We get a movement to the northeast. Okay, that makes more sense to me. I think that the stock markets, whilst I think that the earnings have been fantastic, and I think that the earnings are supporting the market, and I think that we are in stage 2 of the of our cycle. What's stage 2 of the bull market cycle? That is called improved earnings. I think that we may be getting pretty close to the top or the apex of a cycle point here. I think that the risk markets may be due. I think the risk markets may be due a pullback, and I think that you guys need to just be very, very careful if you are trading risk markets, or if you've got longer term holdings. I've got some longer term holdings. I think they're going to pull back, and so we just got to kind of absorb that gut punch, and then I think that the pullback as the indicators normalize, I think because we are in stage 2 of our bull market, improved earnings, I think that the support levels become exceptionally important then to see if we can get back in on some support. Okay. Are there any questions with what we've done this morning? Please let me know. Are there any questions with what we've done this morning? This is as far as we'll go this morning. Just the idea that we overbought on the risk markets and that the interest rates are moving up, and there should be some headwinds which we haven't seen on the stock markets. That makes me uncomfortable. Let's leave it at this point, guys. I want to wish you a good day, a good weekend ahead, and we'll touch base again on Monday morning. Thanks very much, guys. If you found this useful, again, if I may request that you press that rocket ship boost button, okay, and that just helps with the webinar dissemination, the live stream dissemination. Thanks very much, guys. Speak to you on Monday. Cheers.